When I close a deal, I feel fantastic. It doesn't matter if it's a real estate deal, licensing, private equity, or even buying a car. I feel great. It's like skiing down a steep run at Palisades or Whistler. You feel elated and you want to do it all over again. The satisfaction of closing deals is what keeps me coming back. I'm Jim Nissing, and as an attorney, business and financial consultant, I help business people win the game of money. I've closed many deals and I feel great doing that. I've developed, bought, and sold custom homes, spec homes, and commercial real estate. While those were a lot of fun, I also found more excitement in closing licensing, pharmaceutical, manufacturing, syndication, and private equity deals. I've negotiated over $1 billion of deals, and I had a lot of fun doing it. No doubt, I've had some deals that didn't work out, but I learned valuable lessons from them. I've worked with numerous investment groups that needed funding for projects. The partners wanted to invest as little as possible, so I worked with lenders. We acquired leveraged real estate, and in an inflationary market, we made significant profits. We all remember when the lenders stopped providing reasonable loans. In those times, we turned to syndication. Growing businesses often face the challenge of needing more capital, financing, and investors. When we needed funds, no one in the company really knew how to raise money, so I took it upon myself. Although I initially lacked the knowledge, I learned by talking to firms that liked our company's rapid growth. They required detailed documentation like assumption-driven models, org charts, business plans, security forms, and risk disclosures. I had to learn the intricacies of deal making. This knowledge led to a 4x return for our investors, a substantial profit that made them very happy. This growing return is what I want to discuss in The Game of Money. Let's dive into what I've learned about the game. The first rule is timing. Don't enter too early or too late. I've outlined a curve representing asset or revenue appreciation in deals that I prefer. My focus is on private equity that can be grown and sold or taken public. I want to invest when revenue starts to rise and then exit within 18 to 36 months. I call this the family timeline because it's more manageable than the longer timelines of funds, which can stretch out to 5, 7, or even 10 years. For instance, if I invest $100,000 and can turn it into $400,000, then reinvest that to grow quickly to $1.6 million and do it all over again to exceed $6 million, those are the real returns that I look for. This is the game of money I'm playing successfully today. I've worked with many private equity investors and have been in the game for a long time. There's a clear formula to follow, which includes avoiding the fastest way to lose money, which is investing in overly ambitious tech ventures aiming at 100x or 1000x returns. While innovative tech like asteroid mining, flying cars, and AI are really cool, I don't have the resources or the time required for such high-risk ventures. What I find is that when I start talking to people who are saying, I want to build wealth in the game of money, I ask, how are you doing it? I found out they have two basic wealth building strategies. One is get rich crazy, right? They stumble onto battery tech, med tech, fintech, super drugs, AI, semiconductor chips, all kinds of crazy stuff that sounds like it could be the next big thing. Motley Fool is famous for this. You know, if you read Motley, they say, this could be the next trillion-dollar industry. It's crazy trying to outguess people that do this professionally. And then, of course, there's the other side that investors see, which is the slow money. 10% return, and that's generous. 6 to 8% is probably more realistic, like S&P index funds. That's what investors see because they're not professionals, and professionals suck up all the other good deals. But in the middle is called a 3 to 5x deal or a 4x deal for shorthand. This should be the target and is an accessible target. If you know how to play the game of money, there has to be a game board, right? And in my mind, the game board looks like this. So you could target 100x returns, 1000x returns, whatever you invest in is going to live 2 to 4 years in the valley of death. And emerging from the valley of death in a startup or some early stage developmental deal. An early stage deal has a 1 in 3 million chance of emerging. I understand that venture firms are like, hey, we try to be successful 1 in 10 times or 1 in 20 times. But to find actual raw startups that you'd be able to invest in and find in your day-to-day life wherever you are, it's very difficult. You might randomly stumble across a great deal like, oh, maybe the next AI tech, the space company, whatever it might be, but that company likely has a 1 in 3 million chance of emerging from the valley of death. Take a look at this article from PitchBook. $27 billion up in smoke from 3,200 startups in 2023. Here's how I navigate the game board. I seek investments that are clearly emerging from the valley of death. Instead of chasing unattainable returns, I aim for a 3 to 5x return because these opportunities have been de-risked and stabilized. I invest once the venture is de-risked with a clear path for revenue and profit growth. And then I aim for an exit with a 4x return within a short period of time. I've learned that true players in the game of money avoid extreme strategies. They aren't chasing crypto or stuck in low return investments. Family offices and billionaires typically invest in deals that they understand, where their money makes a difference, and where they can achieve a 4x return. This is what I strive to do with my family investments. I invest in growing companies approximately 2 years before they're ready to sell, targeting a 3 to 5x return. This strategy, like Moneyball, is about finding these deals before other people do. I help structure the deal and position myself for investors for the best possible outcome. Understanding the game of money is different than understanding the game of business. Business is a broad term encompassing everything from product development to employee management and marketing. If you're successful in business, you're likely to have a high margin product or service, a solid marketing strategy, and a streamlined operational process that leads to a healthy operating income. This is the game of business, constantly improving and expanding your margins and safety nets. However, when successful entrepreneurs or management teams excel in business, they eventually need more money and encounter the game of money, which operates differently. The game of money involves different players and rules. One key player is the banker, who always makes money in the deal because they know the cheat codes of the game. For instance, Rivian raised $12 billion for its IPO, and then the underwriters or the bankers got $170 million in fees. The bankers were Morgan Stanley, Goldman Sachs, Chase, and 19 other banks, and they made $170 million. Here's what happened. The investors that were in the deal early and after the run-up, they sold off and the stock went from 172 down to 28. And the company today is around $13. So what happened there? I'm not a public market analyst, but this seems to me what happened. The banks had clients that got into pre-public stock. Those are represented by those green boxes on the chart. Insiders started seeing retail demand, which is the yellow boxes, and then they started selling their insider stock that they got for a low price to a higher price in the retail. They started seeing the price go up, and eventually it went up to 120% of the offering price or even more. And as the price climbed, they continued to sell off from green to yellow. And then once most of the transfer of wealth was made, then the stock falls, crashes. This is the game of money played by bankers using cheat codes that you don't have. And everybody's perfectly satisfied seeing this happen because they're using best efforts, compliance, and they're using risk disclosures. And that's how it can work. Not everyone lost money in the deal. The bankers made $170 million. The players of the game of the money include the CEO, who runs the business and utilizes investor funds, the investors who provide capital, the employees who follow the business plan, and the bankers who set the rules and create securities for other players. In this game, I want to position myself as the banker, setting the rules, coordinating the game, and creating securities that ensures profitability. The game of money is different from the game of business, and understanding its intricacies can significantly enhance your investment strategy. By playing the role of the banker, you can ensure constant profitability in deals, leveraging insider knowledge and strategic timing to achieve substantial returns. So why not play the game of money from the banker's position? Let me explain why this is crucial with an example. You might recognize Jessica Alba from her movies and her TV shows. She founded The Honest Company, which sells non-toxic household products. On the day I looked into this, the market cap was $104 million. The investors in The Honest Company had a 2x liquidation preference on their $50 million investment. This means that if the company was sold for $104 million, those investors would get $100 million, while Jessica Alba and her friends and family would only get $4 million from the sale. To put it another way, the biggest threat to your investment are the other rounds of capital that come in before and after you. If you invest in a deal with professional money that has high liquidation preferences and other unfavorable terms, you're constantly at risk. For example, FanDuel sold for almost $500 million, but the founders and most employees received nothing due to the liquidation preferences. These cheat codes are what I call toxicity in a deal. The cheat codes are minority control, liquidation preferences, board flipping, and drag-along rights. These elements can ruin your investment if you're not aware of them. I avoid deals with professional capital due to their inherent risks. The challenge is finding deals that haven't taken on this kind of toxic capital. As a small investor, it's hard to get into top-tier investments. The best deals are often reserved for those with significant capital and connections. Bankers and top investors set the rules and secure the best returns, leaving smaller investors with the riskier, less profitable deals. To play the game of money effectively, you need to switch from being a regular investor to playing the role of the banker. This means setting the rules of the game and structuring deals to your advantage. But this transition is challenging because, number one, access to deals. Small investors often don't have access to the best deals. If a deal looks great and is easily accessible, it's likely to have already been snapped up by the top investors. Number two, deal analysis. Analyzing deals requires a deep understanding of financial metrics and market conditions, skills that are typically honed through years of experience in investment banking or financial analysis. Number three, capital size. Even if you have access to a good deal and can analyze it effectively, your investment might be too small to make a big impact, or it's too small to even be able to get into the deal. Everyone wants a magic deal, a royal flush with 5 great cards and a low valuation. But these are rare. When all the risks are mitigated and it's just the execution risk left, professional investors snap up these opportunities for their easy Forex returns, leaving little for smaller investors. A good deal or a royal flush involves 5 cards, a solid product, an experienced team, clear traction in numbers, a compelling story, and access to capital markets. Startups, by contrast, often struggle because they lack these elements, and they spend years in the valley of death, a high-risk phase with little guarantee of success. Everyone wants a magic deal with high returns and low risk, but these are extremely rare. To truly exceed in the game of money, you need to find deals that are already de-risked and have a clear path to profitability. This is the essence of playing the game from the banker's position. ensuring that you set the terms and the returns that you want. I want to know that the company I'm investing in has access to the capital market. That's crucial for a good deal. So, is a startup a good deal in the game of money? Not always. Startups live in the valley of death for so long because they typically have only one strong attribute, like a compelling story, but a lack of proven team, traction, or access to capital. As an analyst, I can't properly value a one-dimensional deal. Professional investors are constantly scanning for deals where they can add value with their money and their expertise. A good deal is a workable deal where you can add significant effort. This is where small balance investors can level the playing field. Let's say you find a deal with a solid brand and product and some traction. You need to add a competent team and capital to make it work. This is often too much work for large firms that prefer to write a check and then move on. But it's where we can compete effectively. If we find such deals and put the effort in to build them up, we can create our own royal flush. Is this an original, brilliant idea? Is anybody else doing this? Of course they are. Goldman Sachs, Morgans, and a host of investment bankers are doing it. They've always been doing it. Banks and large investors follow this playbook. They find deals with a few strong elements, add what's missing, and then sell the fully baked deal. For example, if JP Morgan structures a deal, they won't sell it to another major player like Goldman. Instead, they sell it to their smaller investors once it matured to a safer stage. As a small investor, you rarely get into these top-tier deals. By the time they're available to the public, the high returns have already been extracted. You might get an 8% return, but not the 4x returns that the bankers have already capitalized on. So where should we focus our efforts to find these lucrative opportunities? We need to identify the air bubble in the capital markets, a segment where small investors can compete. This area lies between seed capital, which is extremely high risk, and large-scale venture capital deals, which require significant capital. It's a space where 4x returns are achievable without the extreme risk or the need for enormous investments. In this air bubble, we look for deals that have some potential, but need additional elements like professional management or capital infusion. These deals might have a busted story, slow growth, or some kind of issue that scare off the large funds, but can be fixed with hard work and strategic investment. By doing this, we can turn otherwise stuck opportunities into profitable ventures. Playing the game of money effectively means looking for deals that are overlooked by larger players due to the effort required to fix them. By focusing on adding value to these deals, we can achieve significant returns. This approach requires diligence and a willingness to work hard, but it offers a viable path to competing in the investment world. So, what's a good deal? A royal flush, right? Let's summarize a royal flush. A solid brand, a competent team, proven traction, a compelling story, and access to capital. Focus on serious companies that operate in the real economy where we can triple revenues and double profit margins within 18 to 36 months to achieve a 4x return on our money. This is what private equity groups strive for. But here's the key. We do the real work. We can't just play this game with money alone. We often need to add a compelling story and access to capital. And if that's all, that's the easy mode, landing the plane smoothly. To recap the banker's 4x playbook, great deals are made, not found. Cashed up insiders and pros vacuum up the easy wins. You won't stumble upon an easy win without putting some real effort in. We're not looking to capitalize on someone else's high-risk idea. We want to largely de-risk opportunities that only require execution. Thus, we create the deal. Now, let's consider the big cycle, the rise and decline of empires and macroeconomics. Cycles start with a new world order. Bitcoin rises, creating enthusiasm and excitement in the economy. Then we see innovators like Airbnb competing with hotels and Dropbox using other people's computers for storage. This leads to a financial bubble, wealth gaps, and eventually a market crash. Examples include Tesla's stock bubble, First Republic Bank's collapse, and FTX's implosion. The economy faces downturn, revolutions, and restructuring before entering a new cycle. That's the macro cycle. If that sounds like too much of a conspiracy theory, let me just pull out a page of a 101 economics book or even the Encyclopedia Britannica. Expansion leads to a peak, which leads to a contraction, and then recovery. In 2001, top performing sectors were information technology, financials, communications, and consumer discretionary. By 2022, we peaked, and by 2023, we started contracting with healthcare, utilities, and consumer staples performing the best. Now we're hovering around recovery, with industrials expected to perform very well. So here's the strategy. Number one, enter deals where there's no professional money involved and avoid toxic professional terms. Number two, look for royal flush deals with a strong team, traction, a good product, access to capital, and a great story. Number three, understand where we are in the macro cycle and position yourself accordingly. I've created and invested in several royal flush deals that fit this criteria. If you're interested in learning more about these deals and how to get involved, I invite you to a free coaching session. If after our free coaching you find yourself eager to learn more, we can discuss that. If not, you'll still leave with valuable insights to apply immediately to your business. No sales pitches, just genuine support. Just click below or go to jimnissing.com to schedule your exclusive VIP coaching session with me.